And now to our market monitor who likes big cap U.S. stocks. He is John Traynor, Chief Investment Officer at People's United Bank's Wealth Management Division, which manages $5.5 billion. When he was on in January, he recommended Oracle, which is down about 11%, Express Scripts, which is off 2%, and Whole Foods, which has gotten clobbered. It's down about 32%. Welcome back. Nice to have you back, John.
Thank you, Sue. Thank you. Nice to be back.
Let's start, first of all, with whether you still hold those three stocks. And then secondly, what do you make of the risk on in this market this week?
Well, the first two that you mentioned, we still do own. We still like them. Whole Foods, we actually sold in the spring. We did not see the continuation of the good news that they had in the fall. The comp store sales started to fall off, so we decided to step aside. We have it on a watch. We may go back in, but we don't own that stock now. And when it comes to the risk on, as you asked, we've seen that so far this month. The stocks and the sectors that didn't perform well in the third quarter have been the leaders so far this month. So, for the first few days of this month, the risk on trade is working.
Let's get you to walk us through some of your picks this time around. You have three big blue chips beginning with Disney. Are you not concerned with something that a lot of investors have been as you see that fall off there in August, and that is cord cutting and maybe reduced fees for some of the cable properties?
Yeah, we use that fall off as a buying opportunity for Disney. And the big news with Disney, the company's doing very well, but the big news that investors focused on was really ESPN and the potential for cable companies for them to lose cable subscribers. But if you look at Disney, my clients, your viewers, they want to own what Disney produces. So there's a whole field of narrowcasting that we think the street is missing, that Disney will be able to deliver that content to many more individuals. So we think this is a great buying opportunity for Disney.
All right, Home Depot is next on the list with a price target over the next 12 months of $131 per share. Play on the housing market?
It is, and the real key here for your viewers is to focus on household formation. Since the end of the recession, formations through the end of 2014, household formations were running in the basically 500,000 to 600,000 per year. Since the beginning of this year, they've been averaging over 1.6 million per year, which is fantastic. Those are all new formations. Those are all new home buyers, new condo buyers. So there's a tremendous pent-up demand for what Home Depot is selling. So we think they're really, the wind is at their back.
All right, let's move on to the third one, which is United Healthcare. How high, how soon, and why?
We like United Healthcare for a couple of reasons. It's a major beneficiary of the Affordable Care Act, which everybody's aware of. But as the dominant player in the industry, some of their competitors are merging to be able to achieve the mass that United Healthcare has. They are driving cost containment as we move forward, and that's going to be a very positive story for them going forward. They're gaining new customers through increased insurance. So they're a real beneficiary of the Affordable Care Act.
All right, and the price target in the next 12 months is $129 per share. John, thank you very much. Have a great weekend.
Thank you. You too.
John Traynor with People's United Wealth Management.